Hello everyone, welcome to our Egyptian online seminar group. First, keep your off. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming dear Professor Partha Mohanram. Professor Partha is a professor of in accounting at the University of Toronto. He obtained his PhD in business economics from Harvard University. Professor Mohanram has published in top-ranking journals in accounting and finance. He has won a lot of awards for his research, including the notable contribution awards from the American Accounting Association. He serves as the editor-in-chief of contemporary accounting research and on the editorial board of Accounting Review and the Review of Accounting Studies. Now we will start our seminar with the Professor Partha Mohanram.
Mohammed, thank you very much for the invitation as well as the introduction. I presented in the seminar, I think in 2020, early days of the pandemic. So it's nice to see that you've continued to run the seminar and it has become extremely successful and probably one of the leading, virtual seminar presentations in the world. So very glad for the opportunity. Thank you all for attending. So without further ado, I'm going to discuss my, oh, sorry, I think I went all the way to the, I don't know what happened there. Okay, so this paper is joint work with Sanjeev Bhojraj, who's at Cornell University, Suning Zhang, who is at Iowa State, and Abdul Kaiser, who is from PhD from the Indian School of Business, who's currently a postdoc with us at Toronto. So before I start talking about the paper, firstly, I want to mention that this is a very early stage paper. And we've just been working on it for the last few months and finished a draft just a couple of months ago, presented it in a few places. So we are certainly willing and open to all kinds of comments, which will help us improve the paper before we submit it. Also, as Mohammed mentioned, I'll be presenting seminar style, so you don't have to wait till the end. You can ask me questions anytime. I don't know, how does it work, Mohammed? Will you just people raise hands and they just ask, or you'll tell them to go ahead and ask the question, or?
Yes, if anyone have any questions, you can open your mic and ask your question.
Yeah. So you don't have to raise your hand. Just, please feel free to just turn your mics on and ask the question, and I'll be happy to answer. Please introduce yourself if just so that I know who you are and everybody else knows who you are. Okay. So before I talk about the paper, which is about the wisdom of Robinhood investors, I just want to talk about individual investors, and how they have been regarded by both practitioners and academic research. So it's my opinion that individual investors are often the subject of much ridicule by both practitioners and academic research. A lot of academic research seems to indicate that these investors are naive and make poor trading decisions. So I'm just to give you an example, and this is one of many papers, and we cite a few of them. Babarodin show that individual investors' portfolios are often very inefficient in the sense that these guys trade too often. They don't really make money. They would be better off just investing in low-cost index funds. And practitioners especially, pardon me, practitioners view individual investors essentially as almost victims or chumps whom they can take advantage of. In fact, we have a citation in the paper. It's in one of the footnotes where an institutional investor, I think a hedge fund investor, basically says, generally the answer is, if retail investors are trading something, we are happy to be trading it. Dumb money remains super dumb. So this notion that these guys are just either noise traders or liquidity traders, and they certainly don't have information, and they're often at the other side of informed traders. That seems to be the general view of individual investors in the literature and practitioners. So which brings us to our paper. So I just want to make a couple of clarifications. Our paper is about Robinhood. So some of our results may or may not generalize to the sample of individual investors. So that's why our title says wisdom of the crowd, and it has Robinhood investing in the title. Wisdom of the mob, and it has Robinhood investing in the title. So Robinhood was this trading platform which was introduced in 2013, and the most attractive thing was it allowed commission-free trades to unlimited commission-free trades to individual investors who basically Robinhood makes its money on sort of aggregated order flow, and some people will say that this is not really free because the execution of Robinhood, in terms of when and the exact price you get your trade at, may not be as good as you might get in some of the other platforms. But the fact is, from a practical perspective, you trade and you don't pay, a cent in commissions or whatever. And this has led to a dramatic increase in individual investors. And it's also changed the nature of individual investors because they are far more active, and also they're far more likely to be actively engaged on social media channels like Reddit and Twitter and stuff. In fact, there's a lot of anecdotal evidence of Robinhood investors, quote unquote, organizing and coordinating among themselves on, bulletin boards such as Reddit. Um, Now, Robinhood itself has led to sort of spurred some academic research. And in general, most of the research on Robinhood has largely confirmed the prior research about individual investors not being very, smart or successful or whatever. So, uh, for instance, Eaton and all, they actually show that, they show by almost by elimination that Robinhood investors make capital markets less efficient, because they show that in the time periods when Robinhood was out of action for whatever reason, there was an outage on Robinhood, markets had improved liquidity, improved less order imbalance, less volatility, and so on and so forth. And these are all things that, from a microstructure perspective, you would consider as signs of, poor market or whatever. So Robinhood's absence makes things better. Uh, Getting to the trading itself, Barber et al. Show that Robinhood traders indulge in attention-induced trading with their aggregate buying actually predicting future negative abnormal returns. So if a bunch of Robinhood traders are buying at any point of time, the returns immediately following that time period will be negative. And Michael's 2003, or Michel's, I don't know how to pronounce it, uh, basically looks at the time period after earnings announcement and finds no support for informed trading on the behalf of Robinhood investors. Now, there is one exception to this, and there's a paper by Welch which shows that Robinhood investors' investment decisions are actually associated with good timing and positive alphas. So one thing to think about is there's obviously some internal inconsistency among these papers. And so what we are trying to do in this paper is we focusing on why Robinhood investors or investments might actually uh, provide information to capital markets. And we are trying to draw a parallel from a literature on social media and the literature on wisdom of crowds specifically. So overall, the academic research has been quite dismissive of Robinhood, and you've even had people referring to the investors on Robinhood as a mob. So in some sense, what we are trying to ask in our paper is, could there be wisdom of the mob? And like I said, what we are doing is we are relying on the literature on wisdom of crowds. So before I get into the actual papers, let me spend 1 minute talking about what wisdom of crowds is. Wisdom of crowds is this phenomenon which was made popular by British social scientist of the 19th century and early 20th century, whose name was Sir Francis Galton. And he would run these experiments. Like, for example, he would go to these street fairs in rural Britain where you'll have contests like guess the weight of this cow or something like that. And he would have like a few experts making some guesses. And then he would have some random, just the random, the populace who attend this fairs making a guess. What he found was invariably the the if you take the average of what the different people, the non-experts, were guessing. Firstly, the distribution was all over the map. Some were like completely off above and some were completely off below. But if you take the central tendency, and I don't remember if they looked at medians or means or whatever, but if you take the average of um, what the crowd was saying, it very often was as good or better than what experts were guessing. And this is exactly what is the notion of wisdom of crowds. Okay, and we rely on this notion of wisdom of crowds. When I say we, I specifically mean me and my co-authors, different co-authors from this paper, myself, Eli Bartov from NYU, and Lucille Forel from Arizona State. So in our 2018 TAR paper, we basically show that, if you look at the information on tweets from ordinary investors and you kind of parse it out and do some lexical analysis and sort of extract the sentiment, aggregate it. And if you find that if there's an aggregate positive sentiment in the time period just before earnings announcement, there's actually a positive earnings announcement for those kinds of firms. Conversely, if there's like negative sentiment, there is like negative, earning surprises and stock returns, in the time period after. So, in our 2023 paper, so one of the things we noticed in that first paper was our results were stronger for negative information as opposed to positive information, which is related to the fact that maybe positive information on social media channels might be full of hype and have low credibility, but generally negative information is more likely to be credible. And given the importance of negative information to the debt market, so in our follow-up paper, we looked at whether the information from Twitter can have implication for things like bond prices and CDS spreads and stuff. And we found that indeed it does. And that paper was published in Management Science. So obviously, this first paper especially has had a fair amount of impact on the literature, and it gets a lot of citations, and we were fortunate enough to win the Notable Contributions Award from the AAA 2 years ago for that paper, or last year, I don't remember. So ours is not the only paper which looks at that. So there was a paper published, I think, in RFS, I'm not sure, or Journal of Finance, which looks at seeking alpha. So it's quite different from Twitter, because Twitter was just like ordinary people tweeting and we're aggregating. But seeking alpha is not exactly an ordinary person. It's just somebody who's done some research and analysis. But still, it's not somebody who's officially affiliated with a brokerage firm or with the company or whatever. And what they find in that paper is that, that information is actually relevant to, the prediction of stock returns. More interestingly, from an accounting perspective, there's a paper by James et al., which looks at crowdsourced earnings forecasts on this platform called Estimize. And what they show is that, when ordinary, individuals, they could be investors, they could be, amateur analysts, or whatever the case might be, these people are putting out earnings forecasts. And you consider their earnings forecast and you sort of take their consensus earnings forecast, that actually does as well or better than what you'll find on, IBUS, which is focusing on professional forecasters, right? People who work in sell-side equity and so on. So that's the wisdom of crowds, and it's been shown, like I said, in different settings in the literature. And so what we are doing is there a wisdom of the mob? That is, even though these people on average are, or in the literature have been shown to be generally naive, are there some settings in which there could be information in what they are, in their trading decisions or whatever? So that leads us to our research questions. But before I do that, I want to just make one caveat out there. So the question some of you might have is, how do you reconcile the fact that you find that the trading decisions of Robinhood investors are potentially contain useful information from this literature which shows that they lose money and they're attention induced trading and so on and so forth? The answer is, we are looking. So firstly, I'm not claiming that Robinhood investors are always informed, and I'm not even claiming that on average these guys make good trades. All we are saying is, if you examine that trading behavior in the time period before the earnings announcement, there is some evidence that that trading behavior seems to predict earnings announcement, i.e., there is some information there, right? So, which doesn't preclude the fact that they could be doing uninformed or poor trading in other time periods. Now, in some sense, we are using the same setup in our paper as we do in our um, as I do in my, I don't want to use the word we because it's a different set of co-authors, as what I do in my Twitter paper, where we examine a phenomenon. As we examine either like Twitter in that paper, or here we examine Robinhood trading in the time period just before earnings announcement, and ask ourselves, uh, does the quote unquote positivity or negativity, so in the case of Twitter, it will be the sentiment. In the case of Robinhood, it will be the sort of aggregate buying or aggregate selling. Does that predict the likely, earnings surprise and stock returns and so on? So that leads me to my research question. Oh, by the way, I'm going. I'm rushing through my paper. I'm like 20 minutes in, and I have covered like almost, one third of my slides. So please feel free to stop me at any time if something is not clear, or I'd be happy to answer questions at the end as well, whatever works. Okay. Um, in addition, I have the floor here. If you have any other general questions about, my research, about CARD, the journal, or whatever, right? I'd be happy to answer those as well at the end. Okay. All right.
Hi, Partha, I have a question.
Yes.
So yeah, my name is Alicia, student at Cornell. So I'm wondering about kind of the story here, and how it relates to the GameStop and the AMC saga, with respect to like retail trading and how institutional investors reacted to retail trading. And so I wonder, is it because kind of on average there is some information in the aggregated trading behavior of the retail investors, or is it because that they could be significant enough in aggregate that like other investors need to pay more attention to their trading? I know like maybe you're looking at the earnings setting, but I'm kind of wondering like in
Right.
general.
I think that's a fair point, and a couple of things. So firstly, that that whole game stock, AMC, and all the sort of meme stock trading things, right? That actually is what provides like tension to our basic story, which is like, on average, there is little evidence to suggest that these guys could have information. If anything, these guys seem to be coordinating and going after firms for things which have nothing to do with fundamentals, right? In the whole AMC and GameStop thing, they just, if I'm not mistaken, they targeted firms which had a lot of short interest. And I think they were looking at things like expiring options and stuff. So they were really focused on a very much a microstructure based thing, which has nothing to do with fundamentals, right? So our setting is very, very unique and stylized because we are looking at the time period before earnings announcement. And uh, I think it's fair to for all of us to agree that the earnings surprise is completely exogenous to the trading behavior of these people. So there's no endogeneity there, like in the sense that these guys are not going to cause the earnings surprise by their trading. The earnings surprise is based on fundamentals. So this is like a very direct test of is there something these guys do which identifies firms that are likely to have positive and negative fundamentals in the time period going forward? So to answer your question, and I think that's why it's important to look at these things in a very contextual manner. It's very difficult to say that retail investors are good or retail investors are bad. All we are saying is that in this setting, information from the aggregate trading of these retail investors seems to predict fundamentals. So that's the extent to which I'm willing to go. Okay, so I hope that kind of answers
Yeah,
it.
that helps. Thank you. And also, I wanted to ask a second question with regard to the prior studies that you mentioned, estimized, for example. So, I'm wondering if you could help me better understand the difference between the setting and the crowdsourced estimation in estimized. Is it different in the sense that if we look at Robinhood trading, like people are actually putting money in where putting
See,
down
I
money and
think
actually, yeah.
yeah. So I think estimate setting is closer to the seeking alpha setting, right? Because in the sense that if you look at the distribution of, in fact, I'm guessing that the distribution of the kinds of people who have accounts or estimates at seeking alpha is probably quite different from the kinds of people who have accounts on. No, I'm by the way, I'm sure people on estimates and seeking alpha might also have accounts on Robinhood. I'm not denying that, but I'm just saying the average person on Robinhood is unlikely to be super sophisticated about fundamentals and so on and so forth. I think the difference between an estimate and seeking alpha are more people who are uh, um, how do I put this? They're like amateur professionals, if you know what I mean, right? These are all people. If you look at us, for example, if you go look at the analyst reports you can find on Estimize, or if you look at the data, or if you go and look at the actual seeking alpha reports, these things are really quite sophisticated. The only thing is this person who's doing it is not necessarily is not definitely working for like a Goldman Sachs and a Morgan Stanley and stuff, right? So we're talking about something quite different here. So, but. So yeah, but the basic in fact, so that's why we use these as motivations. And of course, the biggest difference between um, this setting and those settings is in those settings, they give you information and we are testing whether that information is good, at least in the seeking alpha and this thing, right? In the Twitter thing, they don't give you information. They give they're giving you opinion, which can still easily be classified as positive or negative. Here we are inferring opinion from their actual trading decisions. So in one sense you can argue that these are very unsophisticated people, blah blah blah, but in the other sense you can also argue that there's nothing more credible than putting your money where your mouth is, and these people are actually trading, as opposed to Twitter could be cheap talk, for instance, right? So this is unlikely to be the case. Okay.
Yeah, thank you.
So, Partha, I have a question about like how far in advance are you able to predict the fundamental? And what will be the main information that helps predict the fundamentals that, Robinhood, yes, 10 point something million traders are informative.
Yeah, that's a fair question. And I think, if I'm not mistaken, we use a reasonably short window. I think we use information about the trading activities from 4 days to 1 day before earnings announcement or something like that. I think that's what we do. I'm not sure. Uh, I don't know if any of my co-authors are on the call right now, but maybe Abdul is. I think if we extended it backwards, it really didn't make much of a difference because the trading tends to be very, very clustered in the time period just before earnings announcement. So if you go to a firm, and remember the earnings announcements are kind of known beforehand, you don't find much trading activity in the time period like 10 days and 6 days and 7 days and stuff. And part of the reason is what we have noticed, and this is not part of our analysis, it's just something that we noticed, is Robinhood investors get in and out of stocks very, very quickly. And the reason is simply because trading is free, or at least, it's notionally free because they're not paying any trading commissions. And I'm guessing these people are capital constrained. So they don't have the ability to just invest in all stocks and remain there and just hold on and sell a little later and stuff. So they get in and out because they want to just get a quick pop around the earnings announcement and then they want to leave. So that's the reason, going further back really doesn't make much of a difference in our setting.
And then what type of information is the most important
So
that
that
helps
is,
them?
see, that is a very good point. And so for those of you, I don't know, Mohammed, do you share the papers with the people or they don't have a copy of the paper?
We don't.
No.
Okay. So Luminita, just hold on to that. So basically, if you look at our main presentation, right? So what we have in the paper right now is we have some tests which look at, are these things informed? And then we do some cross-sectional tests. And then we also look at some other test of whether, things like the presence of institutional investors and shorting and all makes a difference. And finally, we look at the impact on longer run market efficiency like drift and so on. But we've also been doing some preliminary analysis of trying to look at the determinants of which kind of firms Robinhood investors like to buy or get into in the time period before earnings announcement. And some of the determinants we look at are things like prior earnings announcement, prior surprises, and so on and so forth. And so at least the way the results appear, and I'm sure I'll get to it by the end, it seems to suggest that at least on aggregate, these people seem to have a sense of which firms are likely to have a positive earnings surprise, and they sort of get into that firm, right? Now, so all I'm saying is obviously it's impossible for me to know what exactly the source of the information is, but at least it suggests like where they're potentially getting some insight from. But so hopefully by the end of the presentation, you'll get some kind of an answer to that question.
Thank you.
Okay, so our first research question is, can Robinhood, this thing is blocking my, okay, can Robinhood trading predict future fundamentals? Okay, so if traders are informed, right, they will in aggregate be able to predict future fundamentals. So they will know which firm they should be buying and which firms they should be selling, right? And if Robinhood investors know this, and they will increase their positions in firms which are likely to have positive news and decrease their positions in firms which have negative news. So aggregate, what we expect is that the Robinhood trading should be value relevant. That is, it should be positively associated with the earnings surprise. So our proxy for earnings surprise is unexpected earnings, and which is simply the earnings realization minus the most recently available expected earnings for a firm. And the dependent variable is this change in Robinhood holdings, which I'll briefly discuss, in a few minutes. And then what we do is we try to control for a few other, known determinants of um, unexpected earnings. So, for example, we know that unexpected earnings have a sort of a serial correlation. Then we also consider the returns in the time period just before earnings announcement. So sometimes there is information leakage, and so there is an anticipation effect. And firms which have positive earnings in the time period just before the earnings announcement are likely to have a positive earnings surprise. So we control for that, and then we control for some firm characteristics like size and analysts following institutional investment, market to book, so on and so forth. And if our analysis, if our hypothesis is supported, we'll expect that the coefficient on this beta 1 on the CHRHI will be positive. Okay. I'll get to the definitions of these variables, in a couple of slides. So the first research question focuses on fundamentals, the prediction of unexpected earnings. Now, the second question, research question, focuses on the announcement period returns. So in these tests, we are essentially following the basic research approach in my 2018 Bartov et al. Paper, where we first look at unexpected earnings and then we look at stock returns. Okay, so you can argue that the first question is a test of information relevance or value relevance, but that may not necessarily mean that this information is new to the capital markets. So it's possible that, Robinhood investors are they are picking up some information, and they're trading on it, but the information is also coming to the stock market in some other way. Yeah, in which case, um, we will not find that their trading is associated with uh, announcement period returns, right? So you can view this as a test of incremental value relevance. So what we do is we just replace the unexpected earnings as a dependent variable with the stock returns in the announcement period, CAR 0. And again, we would expect the coefficient to be positive. Now, we run this in two ways. In the first specification, we use the same independent variables as the ones for the regression for unexpected earnings. But in the second specification, we also throw unexpected earnings in the equation. So basically, if you look at the beta 2 on unexpected earnings, that's like just an earnings response coefficient. What this is saying is obviously the markets might react, but the markets might be reacting to the unexpected earnings. And so we should control for the unexpected earnings and see if there's still some information in the Robinhood trading. Because remember, Robinhood traders might be trading on some long-run positive news about a firm or information about the riskiness of the firm or whatever the case might be. And in which case, it's not necessarily going to be showing up in the short-term returns necessarily. So that's why we do it in both ways. And then we also consider some cross-sectional analysis. Now, if Robinhood in trading is informative, it should provide greater incremental information to firms in weaker information environments. So we consider the following partitions: small versus large firms, firms with lower and higher analyst following, and firms with higher bid-ask spreads. Okay. We also consider a few other partitions which may not be directly linked to information environment, and one of them is the level of institutional investment and the level of short interest, because related to an earlier question somebody asked, there's some evidence or at least anecdotal evidence that Robinhood's investors like to focus on, firms which have short interest and stuff. So, all right. Let's move on. Our final research question looks at whether Robinhood trading helps make markets more efficient. So if because of Robinhood and the information that Robinhood investors are bringing, stock markets are reacting more efficiently to earnings and earnings news, then it must be the case that there will be more efficient processing of earnings information. And therefore, we might find lower post-earnings announcement drift. And that's what Sanjeev, Suning, and I had shown in our earlier 2020 JE paper, which looks at ETFs, where we showed that when you have sector ETFs, which we argued make markets more informationally efficient, you did have lower drift. Okay. So basically here, what we do is we look at the sort of standard feed regression where you have the announcement period. Sorry, you have the returns in the 60 days after the earnings announcement, and you have the SUE, and we use sort of ranked version of it. And if there's a positive coefficient, it shows that there is drift. But we interact this with the level of Robinhood in investing to see if the drift is, increased or mitigated. We also look at the actual earnings announcement period to see if markets are more reactive to earnings in the presence of Robinhood investors. And so just to give some sort of channel through which the drift mitigation might occur. Now, as it happens, we don't necessarily find support for the CAR 0, but we do find some evidence for the CAR 160. Okay. All right. Now, let me just talk briefly about the data. Okay. So our primary source of data is this database called RobinTrack, which used data from Robinhood. Now, this is data which is unfortunately, its availability ends in August of 2020. And it's a very crude, while it's a database where you have ability to look very accurately in time. And so right now we are using it at the daily level, but we can even refine it to like 5 minutes before earnings announcement and stuff. Because nowadays, data on earnings announcement is pretty accurate in terms of, exactly when it's happening and so on. But all you have data is, you don't have, I really don't have data on how many shares were bought or what is the aggregate number of shares bought by people in Robinhood. All I have is how many accounts in Robinhood had owned the stock. So, and I have that at different points of time. So if 4,000 Robinhood investors owned the stock yesterday and 5,000 own it today, I have the difference of those two. And I can convert that into a percentage or whatever it is. That's what we have. Okay. Now, also, what we don't, we can't assume, and this is just a leap of faith, is just because more people own it doesn't mean that in aggregate the number of shares owned by Robinhood investors was higher, because it's quite possible that the ones who owned it own less, while the ones and even though there was an increase, right? So they could have had a net sell. So we don't know about that. But that's just an assumption that if more people own it, on average, it must have been positive buying, and if less people own it, it must have been an aggregate negative, more aggregate selling. Okay. In
So
addition,
Partha,
yeah.
one question, like, do you know if they owe it for which industry, so that you can see the movement across industry? Like, for example, I can be owning a stock in pharmaceutical, and then I see that, things are not looking that good. I'm going to change myself and sell those and go and
We have
invest.
no information
Other
about individual. We have no information about
information.
individual
Okay.
accounts. All we
Okay.
have is for every firm,
Yeah.
we can tell you how many people own that stock.
Okay.
That's our data. So
I
if
see.
I'm looking, so let's say Apple has earnings announcement coming up on March 31st. I have data on each of the days, like, March 30th, March 29th, March 28th, March 27th. How many accounts on Robinhood owned Apple on each of these days? And so the difference or the growth in change, I don't want to say growth because it could be negative as well. The change in Robinhood holdings, so number of people with Robinhood accounts is what I have. That's the extent of my data. Okay.
Thank you.
And other sources of data are, Compostat quarterly fundamentals, IBIS and CRISP for the stock returns. And each observation is an earnings announcement, because everything is done on the earnings announcement sample. And the final sample has around 17,000 earnings announcement, and from 2018 May to Feb 2020. So we stop in Feb simply because, we wanted to avoid the impact of the COVID pandemic. But we can extend our sample, but we can't go much further anyway, because March 2020 is the furthest. August 2020 is the, for some reason, I guess the RobinTrack data is no longer available. That's what we have. Okay. Now, I don't want to spend too much time on summary statistics and also, but just want to highlight a few things, which is these firms are not that small, but there's a tremendous amount of variation. So if you look at the market value, the mean market value is around $9.2 billion, but the median is only $1.8 billion. What is more interesting is the institutional investment, right, is 70%. So Robinhood investors generally invest in firms which have a lot of institutional investments, and that seems to be, interesting. There's nothing else particular here. But if you look at the mean market book ratio, also the market book ratio is high. which means that these guys seem to want to invest in firms which are growth stocks, growth or glamour stocks. So that just seems to be interesting. All right. Now here is the let me just, sorry, this Zoom bar is blocking my view of the table, so I need to move this a bit. So give me one second. Okay. So this is and I'm just showing you a subset of the tables. This is summary statistics based on changes in Robinhood holdings. So we have break our sample into 3 groups based on whether the number of accounts holding a firm decreased, stayed the same, or increased. Okay. So firstly, you'll see that more increases rather than decreases. So Robinhood investors tend to be net buyers. But obviously the change CHRHI follows from that. But what I want you to look at the trends in both CAR 0 and unexpected earnings. So at least at the univariate level, it looks like CAR increases, even though it's a negative number. The negative number is probably an artifact of our sort of 4-factor adjustment in such a short window, and the difference is not huge. It's around 0.3% or 30 basis points. Unexpected earnings, you can see a pretty large increase from like 2.7% to 7.5% across these groups. Generally, again, this is just anecdotal. I don't know what this means. They seem to be buying the positive firms and selling the negative firms. They seem to have a kind of a preference for buying high market to book firms and selling low market to book firms and stuff. But look at losses, right? So they are more likely to less likely to buy firms with losses and more likely to sell firms with losses, which seems to indicate something to do with maybe these guys do pay attention to fundamentals. They are not that naive. The one interesting thing is the pre-ret, we find an opposite pattern, which seems to be contradictory to this notion that these guys are just momentum investors. So these are, if anything, this seems to suggest some amount of sort of contrarian investing on the part of the investors, right? They're buying for far more likely to buy firms which have negative pre-returns and sell firms which have positive pre-returns. So that is interesting. And this, of course, is univariate. So I don't know if any of these will, I mean, we'll have to see if these things hold in a regression setting. Okay. Okay. All right. There's a correlation table here, but rather than focusing on correlations, which kind of generally makes sense, I want to look at we look at quintiles, or I think we look at quartiles here, based on the CHRHI variable to see that the pattern of unexpected earnings and stock returns. And as you guys can see, there is a there is a monotonic pattern in both, not exactly monotonic on returns, but there's a monotonic for unexpected earnings. But certainly the highest CHRHI quartile has the highest unexpected earnings and the highest announcement period returns. And conversely, the lowest CHRHI quartile has the lowest unexpected earnings and the lowest announcement period returns, which again provides some univariate support for our basic story. So the next table is going to be our basic test of hypothesis 1 and hypothesis 2. We put them in the same table. So the first table, essentially, as you guys can see, the CHRHI is very strongly and positively correlated with unexpected earnings. That is, on average, firms which have positive unexpected, growth in Robinhood accounts are more likely to have positive unexpected earnings. Now, and the R squared of the regression is 2.9%. Now, if we look at announcement period returns, you obviously find that there is still a positive correlation, which suggests that this information is relevant and it's new information, which seems to move the stock market. And in the third column, when we control for instead of prior unexpected earnings, when we control for unexpected earnings, so not surprisingly, the coefficient on unexpected earnings is massively significant. T-stat's almost 20, and the R-squared increases from like 0.07% to like 4.9%. So it's a massive, increase, which is not surprising. We know that markets react to unexpected earnings. But what is interesting is the coefficient on CHRHI, while it reduces in size, it continues to remain significant. So the way we interpret this is that if you look at the second column, we interpret this as Robinhood is providing information which is relevant to the capital markets. And we interpret the third column as saying this information is relevant to the capital markets, but it's over and beyond information about the current short-term earnings surprise. So people are not just loading up on a firm because they think that it's going to have a positive earnings surprise, but maybe because they feel as though it's going to have some, long-term positive news, like, maybe information about future growth or information about risk or whatever the case might be. It's more than just the short-term earnings surprise. Okay. Now, what we do next is we look at some partitions. And, in panel A of these tables, we look at the unexpected earnings. And in panel B, we will look at stock returns. And the first three partitions are what I call information environment partitions. So we look at small firms versus large firms, low analyst following firms versus high analyst following firms, small bid ask versus high bid ask spread. As you guys can clearly see in all these three partitions, the results are strongest in what you would consider the weaker information environment partition. So small firms, significant, large firms, insignificant, difference, highly significant. A low analyst firm, significant, high analyst firm, not significant, difference, highly significant. High bid ask spread, significant, low bid ask spread, not significant, difference is highly significant. So this suggests that the information from Robinhood is more likely to be important for firms which have a poorer information environment to begin with. And this is very consistent with what we found in our Twitter paper as well, where the information from Twitter has much greater significance in settings where the existing stock, information environment is weak. Now, we repeat the same for stock returns, and we don't necessarily find that there's any difference. So if anything, if you look at firstly, the returns for results for stock returns are generally a little weaker. And when you start partitioning them, we kind of lose significance. So we find no evidence that the car is significantly different across the information environment patterns based on information environment. Okay. Partitions. Now, if we look at the next thing we look at is we look at the nature of institutional investment. So first partition looks at institutional investment, and we found a strange result that the results are actually stronger when they have high institutional investment versus low institutional investment. Now, remember that this subset as a whole, interestingly, has high levels of institutional investment. If you do in general, if you look at our sample, I think the average would probably be like 60%. Also, nowadays, almost every firm has institutional investment because of the rise of ETFs. And if you have ETFs, and even if you're a part of a Russell 3000, there's a Russell 3000 ETF or whatever, right? So as a result, a large number of firms get classified as institutional investment, and that variable has lost its kind of information value as it used to have like in the past. But what we do is we look at the difference between transient institutional investment and what they call quasi-index and dedicated. And interestingly, what we find is when transient institutional investment is high, the information from Robinhood seems to have significance, which kind of makes sense because, transient institutional investors are supposed to be the ones who care the least about information. So it's quite likely that the information environment is not that strong for those kinds of firms. But when firms have a high level of dedicated institutional investment, right, we don't necessarily find much. It's significant, but it seems to be a little lower. Although I must say that the differences are not significant. Okay, and we find something similar with stock returns as well. When you have a high level of transient institutional investment, this information seems to be slightly more significant, as you guys can see in the column 3 and column 4. So what this seems to suggest is that even with institutional investors, right, these guys seem to have the ability to predict stock returns and so on from their trading, as well as fundamentals. So this seems like unlikely that, the story that these people are so naive that institutional investors take advantage of them. At least that doesn't seem to be supported from our data. Okay. Now, the last partition we look at is short interest. And we look at short interest simply because, that's something which, at least in the practitioner literature and public, in the media and stuff, people have noted that Robinhood likes to go after firms which like short interest. And we find that the correlation of CHRHI with unexpected earnings is actually higher when there's high short interest. So this is, again, this seems to suggest that they're not just doing this randomly going after firms because of short interest. They seem to be doing it because of fundamentals. There's a well-established sort of literature which shows that short interest is associated with mispricing in general. Because in short investors know that firms are likely to be mispriced and stuff. So what this suggests is that at least in aggregate, these guys are able to identify mispriced firms, and potentially that's the one they trade on. Okay, so finally, our final hypothesis looks at the post-earnings announcement drift. Okay, and what we do is we first we're looking at CAR 0, which is simply to see if the market reaction. So in this regression, right, the coefficient on SUER, you can think of that as an earnings response coefficient, right? In the first 2 regressions, and in the next 2 regressions, you can look at the coefficient of SUER as evidence of a post-earnings announcement drift. As you guys can see, there is positive reaction, which suggests that markets do react to earnings, and there is also evidence of a drift. But consider columns 2 and columns 4, where we introduce the interaction with the CHRHI variable. Now, first is, while it's insignificant, at least the coefficient on CHRHI times SUER is positive, and I would say almost significant, which weakly suggests that the markets are paying slightly more attention to earnings fundamentals when there is Robinhood trading. But when you interacted in column 4 with the drift analysis, we certainly find that the interaction is negative, which suggests that there is less drift in the presence of Robinhood investors. Now, so what I'm going to do right now is I'm going to conclude, but I'm going to show you some additional analysis. In fact, let me do that right now. Okay. So one of the things we did was we also split up our drift analysis, which we showed right now, into positive and negative. And what we find is that the interaction is only significant for positive. That is, and which is not surprising, because as I've shown you in the descriptive statistics, Robinhood investors have a positive or a buying preference. And part of it could also be the time period. The 2018, 2019, 2020 was a strong stock market year. So on average, people were buying more than they were selling. And so it's probably true for Robinhood as well. And the interaction is significant for the positive and not for the negative. But the other table which I want to show is we looked at the determinants of Robinhood. What kinds of firms are Robinhood investors going after or loading up on in the period just before stock market returns? And all the variables we use in this analysis are measured before that time period. So these are all things that an ordinary investor could have known. So for instance, oh, by the way, we also include sentiment, which is measured using Raven Pack. So this is the positive or negative media sentiment about a firm. So if you look at the first column, excludes Raven Pack sentiment because we lose some observations. But we can just focus on column 2. What you can see is the coefficient on prior unexpected earnings is positive. It seems to suggest that these, and we know that prior unexpected earnings and unexpected earnings are positively correlated. We saw that in our earlier regression as well, because there is positive serial correlation. But Robinhood investors seem to be aware of it. They seem to be paying attention to sentiment. That's something that we see as well. Also, like we saw before, pre-ret is negative, which means that there is um, evidence that these guys are actually contrarian. Also, these guys, some of the other variables we look at, the coefficient on market book is positive because they have a preference for growth stocks, but they seem to not like loss-making firms. And so all of these are consistent with them having some sort of a selection model for which kind of firms to go after and not go after. Now, again, one thing I must say is this is done at the aggregate level. Potentially, we can do it separately for the ones where the CHRHI is positive and the ones where CHRHI is negative, and see, which kind of variables load up in that. And that's something that we haven't done. Okay. But just to conclude, and I know I have half an hour, so I'll be happy to answer any questions that you have. So our results question the conventional wisdom that Robinhood traders are these naive, unsophisticated noise traders who upset the orderly function of capital markets. So rather, our results suggest that these guys could actually be informed trader whose pre-earnings announcement trades are positively correlated with future fundamentals and returns. And the association is actually stronger for firms in weaker information environments. So they provide information, and they provide information in those settings where the existing information is actually weaker. And Robinhood trading is actually associated with less of a drift. And so basically, to conclude, we can say that there might well be a wisdom of the mob, which is why we entitle the paper that the way we do. Okay. So with that, I'm happy to conclude, and I'll be happy to answer any questions that you might have, about this paper or about anything else, because you have me. I'm a captive audience. I'm a captive presenter rather. So I'm happy to answer any questions for the next half hour.
Thank you very much, dear Professor Partha, for your contribution and your effort. It's really an excellent presentation and excellent paper. Now, if anyone have any questions, you can open your mic and ask your question.
Yes,
Hi.
Alicia, go ahead. Yeah.
Pasha, thank you so much for presenting this interesting paper. So I was wondering, to help better tie this study to other studies that show Robinhood trading is the Robinhood investors are trading in the wrong direction, and they're not informative trading
Yeah.
in general. So I wonder if they, after the earnings announcement, they tend to hold the stocks they sell the stocks too soon for the ones that did perform well, or what is kind of the link here between what you were documenting in the study?
That's an excellent question. And to be sure, in this version of the paper, we are not doing any kind of reconciliation, and that's something that we should certainly work on. Okay. Now, one thing I will say is part of it has to do with simply the time period, but we have done some preliminary analysis which suggests that these guys get in and out of stocks very fast, right? And so what we found is whether the firm has a positive or negative earnings surprise, the CHRHI variable is negative in both subsets in the time period after earnings announcement. So this seems to suggest that these guys are they're all about deploying their capital. So they have a certain amount of money and they are trading on news or expect what they are expecting for a given firm. And once that firm has released its earnings, they just move on to the next firm. Whether that's positive or negative. So maybe that could mean that they are missing out on opportunities by holding on for longer and stuff, but they are active traders. That just seems to be their MO. So that's what we find.
Yeah, thank you.
Yeah, Haye, Chen, you have a question?
Yes, I do have a questions. Hi, I'm Hai. Thank you for sharing your paper. I have a question regarding short interest. Because for the table, I believe that retail investors are not as sophisticated as the institutional investors, right? So the retail investors are primarily considered as net buyers. So they are more possible to long or hold the shares other than short the stocks. So in that table, my question is regarding the Robinhood traders. They might be more likely to again long the position other than short. So why would the results will be a little different than our expectation on retail investors?
So remember here, I am not looking at whether they are. Firstly, we don't have data on whether Robinhood investors are shorting or not. All we have investors is, firstly, I'm not even certain that you can actually short on Robinhood. I believe you can, but all we have data on is how many people own that stock. That's the extent to which we have the data, right? And we are using short interest purely as a partitioning mechanism there. So we are not looking at the interaction of Robinhood with short investors or anything like that, right? All we are suggesting is that remember the variable there is the interaction between unexpected earnings and this variable partitioned by the level of short interest. So if I can just go back to the actual slide, maybe we will make it a little clearer.
Thank you.
Hold on.
If anyone have any questions, please open your mic and ask your question.
Yeah, so this is the short interest table, right?
Yes.
So what you can see here is all we are saying is that if you look at the first two columns, because that's where we kind of get a result, right? As the level of short interest is higher, the correlation of unexpected earnings with the change in Robinhood is stronger. Now, it's quite possible. By the way, this doesn't mean that CHRHI is positive or unexpected earnings is positive. One thing we haven't done is we haven't partitioned this by the sign of the earnings surprise. All we have is the level of unexpected short interest being low and high. So, which doesn't mean that it's quite possible that on average firms which have high short interest might have negative unexpected earnings or whatever the case might be, or might have negative stock returns because there's a reason why people are shorting them, right? So, but we don't necessarily find that. So.
Yeah, I see. Short interest in this way, it's like a proxy of the attention grabbing stops, right? So the Robinhood traders, they maybe pay more attention on the stocks with more attention. So like the short interest stock, high
Right,
short
but
interest,
the general conventional wisdom is that these Robinhood investors go after short interest stocks mainly because they want to do the short squeeze kind of thing, or they want to take advantage of the fact that the short interest guys have to close their positions and all those kinds of things, which is very different from them trading on these stocks because they actually have information about unexpected earnings. So this is a subset where if that was true, you would be least likely to find that the coefficient should be significant and positive, but we find that it actually is. So
yeah, thank you. I see that. Thank you so much.
Professor Samir? Professor Samir Tarabulsi, you have a question?
Hi, Samir. Samir
My-
seems to be silent.
Yeah.
So
Yeah. If you have any questions, please open your mic and ask your question. If you don't have any questions, you can open your mic and ask your question. Thank you very much, dear Professor Parsa, for your contribution and your effort. It's really an excellent presentation. Thank you very much. Thank you very much, everyone join us today. And thank you very much for taking the time to present out to us, dear Professor Parsa. It's been really appreciated.
thank you very much, Mohammed, for the presentation opportunity, and thank you all for attending. Anybody wants to copy of the paper and all, the paper is very early, so we haven't posted it on SSR or anything like that, but feel free to send me an email, and you can just Google me and find my email address and just send me an email, and I'll be very happy to send you a copy of the paper. All right?
Yeah, and I hope to see you soon in Egypt. You are very, very welcome, dear Professor Parsa.
Oh, I'd love to come. I was, because of Samir, I came close. Oh, I think we have a question from Mahmood. That's his hand clap. I'm sorry. Thought somebody's hand was up, but yeah, I came to Tunisia last year to attend Professor Samir Trabelsi's conference, and also went to Morocco. So I came somewhat close, but not exactly. Egypt is next, I suppose.
Yeah, you are very welcome. Yeah, thank you very much.
All right. Thank you.